Let's now discuss how to open the asset account directly. Let me explain the format here. Asset account. Asset account is usually a debit balance. If it is being the debit balance, we have to start with the debit side to balance brought down. Opening balance should be in the debit side. End in the credit side as buy balance. Buy balance carried on. Buy balance carried on. It's simple to keep this point in your mind. If it is being asset account, if it is also being debit balance, right? So the opening should be in the debit side and closing should be in the credit side. If any transaction increases the value of the asset, that should be debited. If the transaction decreases the value of the asset, it should be credited. Is that okay? So I start with opening and closing balances. Let me summarize what are the items will be reason for increasing the value of the assets and what are the items are contributing the decrease of the assets value. Yeah, so purchases is the reason for increasing the value of the asset. Purchases either cash purchase or credit purchase. Then appreciation. Appreciation will also be a reason for increasing the value of the asset. Appreciation. Then reverse of depreciation, right? Not only this, on sale, the asset could have been sold more than its value. So profit on sale of asset. Profit on sale of asset. These are the three items maybe reason for the increasing the value of the assets. In reverse, just opposite. Appreciation, then we have the depreciation here. Depreciation is the reason of decreasing the value of the asset. Purchases, but we have the sale of the asset. Profit on sale in inverse, loss on sale here. Loss on sale. Hope so you could understand. Purchases, appreciations and profit on sale will be a reason for increasing. In a reverse, these three will be the decreasing the value of the assets. Right. Now, this is what about the procedure to be followed in case of charging the depreciation in assets account. Charging the depreciation in asset account. So, depreciation is adjusted in asset account. The another approach where the depreciation is going to be accumulated in the provision for depreciation, in that model, how the account could be. Let's see here. This is WDV model, written down value method. So the value what you have recorded here being the net of the depreciation. Under original cost method, asset account and provision for depreciation account. Provision for depreciation account. Is that okay? Asset usually what? A debit balance, right? So if it is being the debit balance, we usually start with the debit side to opening balance or balance brought down and ends with buy balance brought down or carried on. So buy balance carried on. Is that okay? Now, the provision for depreciation account is a credit balance. Credit balance. If it is being credit balance, we have to start the balance in the credit side. By balance brought down. Opening balance should be in the credit side. Balance brought down. And end with to balance carried on. To balance carried on here. Clear? This is the format you have to keep in your mind. When the asset increasing, that will be debited, and when the assets is going to be decreased, it will be credited. The main reason for increasing the value of the asset being purchases and sale of assets also, means profit on sale of asset also. Profit on sale of asset. Is that okay? Now when we depreciate the asset, we usually, the depreciation is not going to be, depreciation is usually what we do, adjust in the asset account, right? But in this model we don't, so we don't do so. Then the depreciation will be adjusted in which account? Provision for depreciation. It is going to be accumulated in the provision for depreciation account. Is that okay? Not the way how we solved the previous case. Here the depreciation is going to be recorded here, depreciation account. The depreciation is related to the depreciation of all the assets put together for the current running year. Current running year. When the assets sold, the depreciation accumulated on the assets sold up to the date of sale will be available in the provision for depreciation. No more required is transferred from provision for depreciation to asset account. Right. From here to here. From here to here. Provision for depreciation. Provision for depreciation. Is that okay? Here, transfer to asset account. What about this value? This value is nothing but accumulated depreciation on assets sold. Okay. See, this is the provision meant for adjusting any losses on sale. Once the asset is sold, provision is no more required. So, remove from the provision for depreciation account and transfer to the asset account. That's all. Purchases increases the value of the assets, and equivalently we have the sale also, which reduces the value of the asset. And profit on sale will be a reason for increasing the value of the assets, and loss on sale will be a reason for decreasing the asset, loss on sale. Remember the core point you have to note here being, here it will appear at its own WDV value, and here it will appear at its own original value. The amount we name this being the depreciation will be the current year depreciation for all the assets put together. But under this model, provision for depreciation, that current year depreciation will be appearing in the provision for depreciation. Here is current year. Current year. The accumulated depreciation on the assets sold up to the date of sale, no more required. Usually it's available in the provision for depreciation, no more required, will be transferable from here, from provision for depreciation to asset account. Is that okay? These are the core point you have to keep in your mind. The balance of provision for depreciation is nothing but accumulated depreciation of all the assets exist as on that year end, since the date of purchase. Since the date of purchase. Is that okay? Yes, make a note of it.